Welcome back to our class. Previously, we have discussed client-related trading business of investment banks. In this video, we will move on to proprietary trading. Proprietary trading, also called prop trading, is a type of non-client related trading that aims to generate investment returns for an investment bank. In proprietary trading, traders take on short-term investments in securities using banks' own account. Their investment can cover equity and equity derivatives, fixed income, currency, and commodities. Proprietary traders do their own research of the market, and they may also use buy-side research of the bank. The traders closely monitor market prices, follow developments in regulations and laws, and watch for corporate news and macro events on a global level. Basically, the proprietary trading business is similar to hedge funds. The traders may use various trading strategies, including event-driven, arbitrage, global macro, as well as long hedge positions. But as we have learned that hedge funds are among the largest trading clients of investment banks, prop traders have no responsibility to balance the interest between their bank and the bank's investing clients. In this sense, proprietary traders compete with other trading clients in the security market. Investment banks had been significant competitors to hedge funds. As a result, some large funds limited their trading activity with those investment banks that had the largest proprietary trading business. The competition between proprietary trading business and the investing clients of investment banks can result in potential conflict of interest. There are several ways for proprietary traders to have superior information advantage over their trading clients. First, investment bank traders have access to order books of clients. A trader may buy a stock when they know their customers are purchasing in order to profit from the price appreciation that will result from their customers' purchases. Next, proprietary traders may take long positions in some securities first, and then instruct the sales staff to call clients to try and convince them to purchase these securities. In addition, investment banking division of a bank engages in significant corporate events such as follow-on equity offering, M&A, and corporate restructuring. Though prohibited, proprietary traders may have access to what is going on in the investment banking division, which gives them superior information edge in their trading. In year 2007, Citigroup was charged by Australia's Securities and Investment Commission of insider trading. Citigroup was hired as an advisor to Toll Holdings in its bid to acquire Proprietary Corporation. At the same time, Citi actively accumulated the shares of the target, Proprietary Corporation, before news of the acquisition was announced. And during the last financial crisis, Goldman Sachs was accused of betting against its clients, where the bank bundled low-quality mortgage-related CDOs to its clients, but at the same time took short positions against those CDOs in CDS market. Investors, including pension funds and insurance funds, lost billions worth of dollars investing in those CDOs. Proprietary trading using a bank's own account can put a bank at risk. For example, a trader working at Société Générale lost approximately $7 billion in January of 2008. And a trader working at UBS lost approximately $2.4 billion in trading futures contract in September 2011. You may wonder why traders working at banks are willing to take very risky investment positions. A possible explanation is the asymmetric payoffs to traders in taking risks. If their investment generates superior returns, traders can share part of the return in the form of rich bonus compensation. And they can also gain fame as a star trader. And there are no limits in the upside. Star traders may earn bonuses in 8-figure dollars. On the other side, if their risky investment blows up, the worst scenario is to lose the current job. It would be the banks or the traders suffering from huge capital losses. In the last financial crisis, proprietary trading activities exposed investment banks to significant market risks, and major investment banks had failed. To regulate banks' risk exposures, the U.S. Congress passed the Dodd-Frank Act in year 2010, and the U.S. investment banks have been restricted to engage in proprietary trading activities, which means the banks can no longer use their own capital to trade for the purpose of making a profit. While the objective of the Dodd-Frank Act to ban proprietary trading from banks is clear, its effectiveness is still under debate. Because in practice, it is very difficult to differentiate between proprietary trading that aims to make money and normal market-making activities that aim to meet clients' demands, since both proprietary trading and market-making involve trading using a bank's own account. In January 2019, a junk bond trader of Goldman Sachs bought in billions worth of junk corporate bond cheap, and then knocked in the profits as the price of the bonds increased, and Goldman Sachs made a $100 million profit from the difference. Some market observers accuse Goldman Sachs of proprietary trading, but others may say this was just market making, where the Goldman trader helped to buy the bonds from clients who were anxious to sell, and then finally sell the bonds to clients who needed to buy, but at higher prices. From this case, we can see it is practically very difficult to ban proprietary trading. Okay, in this video, we have discussed proprietary trading business of investment banks and potential risks and issues with this business. Thanks for watching. In the next week, we will move on to asset management.